Everyone and their mom expects the Fed to cut interest rates a lot in 2024, but they could be in for a rude awakening. Unlike most investing channels, this one is run by two experienced investment professionals with a strong track record on our rates and inflation calls. We don't give financial advice, but this person was able to use the insights gained from our Inflation Outlook 2024 video to double his money in a short period of time. This video will bring you more professional level market insights like that one. Back then, we showed how the lagged impacts of rent and owner's equivalent rent were likely to drag inflation down faster than expected. So if we add Zori to that chart, but move it forward 6 months, we can get an idea of where CPI rent might be heading. That's still likely to play out over the next few months, but new information shows that later in the year and in 2025, inflation could stay stubbornly high. That means three things for investors. First, the Fed may not cut rates as much or as quickly as expected. Second, long-term rates could go back up. And third, stock market investors could be disappointed. Let's start with why inflation might stay stubbornly high or even reaccelerate later in 2024. To predict inflation, you have to consider what's driving inflation. For a while, it was goods. When everyone was cooped up in their houses, they spent more on computers, home improvements, and other stuff at a time when there were major supply chain disruptions. That limited supply met heightened demand, which was boosted further by excessive stimulus spending. And that led to massive goods inflation. Services inflation was higher than normal too because of worker shortages and rising utility bills. But it was much lower than goods inflation. Then, as the world went back to normal, supply chains slowly unclogged and people could go out again. There was more supply and less demand for goods because people already had all the stuff they needed. Instead, they shifted their spending to services like traveling, restaurants, and movies that they'd been missing out on for a long time. That's why in 2022, goods inflation tanked while services inflation rose. In the fourth quarter of 2023, we actually had deflation in goods prices. Prices for clothing, furniture, appliances, and cars all fell. So why does that matter? Because obviously this is not sustainable. I'm not saying goods prices will skyrocket like they did in 2021 and 2022, but that's about a third of the overall PCE index that could be rising from where it is today. That's going to make it a lot harder for overall inflation to keep falling toward 2%. And how about services inflation? Will that come down? Maybe, but probably not to 2% in 2024 without a major economic slowdown. The labor market is still very strong. The unemployment rate is near a 50-year low, and wage growth is still rising at about 5% per year, which is faster than inflation. A lot of the pandemic stimulus has also yet to be spent, and both Trump and Biden showed little fiscal restraint in their first terms. If Biden is reelected, we'll probably get more protectionism and more government spending to win back low-value manufacturing jobs. That will be inflationary. If Trump is reelected, he plans to massively increase tariffs and cut taxes, which would also be inflationary. And if you think the labor market is tight now, just wait until either Biden or Trump does something to greatly reduce the immigration we've been seeing. Less labor supply means a tighter labor market, higher wages, possible worker shortages in certain areas, and thus higher inflation. I'm not saying we shouldn't get our border under control, but a mass deportation scheme would definitely be inflationary. It's for these reasons that I think the Fed is going to be cautious about how much and how quickly they decide to cut interest rates. Their credibility is everything, and as long as the economy is strong, they have all the incentive to keep rates high until they're very confident inflation will fall to their 2% target. Given what I see coming, I'm not confident it will fall that far in 2024, and maybe not even in 2025, depending on the next president's policies. You remember why they had to raise interest rates so much in the first place, right? Because of policy-driven inflation. If you think we're immune to that over the next 4 years, or only the candidate you don't like has inflationary policies, I'm afraid you may be disappointed. Right now, the market is pricing in about 5 interest rate cuts by March 2025. If they don't cut that many times and the market starts to price in inflation staying higher for longer, intermediate and long-term bond yields will likely rise, meaning their prices will fall. That was my prediction for 2023, and it's exactly what happened. That was my prediction for 2024, and it's exactly what's happened so far. If the economy really is as resilient as most people think, it wouldn't surprise me if the 10-year Treasury yield rose back toward 5% again. And by the way, even if the Fed does cut rates a few times, that doesn't necessarily mean the 10-year yield will fall. Historically, before quantitative easing pushed down long-term bond yields, the real 10-year Treasury rate, aka the 10-year Treasury rate minus inflation, averaged about 2%. That means that if inflation is in the 2.5 to 3% range, a 10-year treasury yield in the 4.5 to 5% range would be pretty normal. That would imply more downside potential for intermediate and long-term bonds from here, since the 10-year treasury is currently below 4.3% as I'm recording this. Given that you can still get a much higher yield on short-term bonds, I still prefer those as a way to reduce my interest rate risk and collect a higher coupon while I wait. That brings us back to the impact on the stock market. I can see this going one of two ways, but both are likely to disappoint equity investors. Scenario 1 is basically what we just outlined. The economy stays strong, inflation stays stubbornly high at 3%, give or take, and the Fed doesn't cut interest rates as much as expected. All else equal, that will be negative for stocks because rising rates directly reduce the value of their future earnings, and thus their stock price. Obviously, that's not the only factor that impacts stock prices, but it would be a headwind for them. Scenario 2 is one where we get an economic slowdown and both rates and profits fall. Personally, I do still think there's a decent chance of this happening. In a nutshell, I think the impacts of the pandemic stimulus are still working their way through the system, and when excess savings have been depleted, consumer spending will weaken. I also think Fed rate hikes haven't really been felt yet because the tight monetary policy has just been offsetting the loose fiscal policy. This is definitely not a consensus view, but if it does happen, we're likely to get the rate cuts the market wants, or maybe even more. However, in that scenario, corporate profits would likely fall and unemployment would likely rise, which are not really in the projections right now. At historically high valuations for US stocks, especially rate-sensitive tech stocks with very lofty projections built in, a lot has to go right for this to work out. Personally, I remain cautious on US equities from here. And by the way, if you want to continue the conversation, check out the link below to my free Discord, and I'll see you in the next video.